Morning, everyone. Bill Holleran here with Jim Franklin and Tiffany Richardson and some folks in the center as well. The important session today, they're all important, but we begin our progress now of assessing your market potential and turning it into the start of a revenue projection. And I want you to be ready for week 6 with Jim as we begin to build the financial template. The agenda today of the curriculum was pretty straightforward. We'll review TAM planning and take it all the way into targeting your market. And I'll walk you through a number of examples of how this is done to actually come up with a numerical sales projection. And then we'll talk a little bit about probability models and market capture. And then we'll finish the session with pricing strategy. There's a multitude of those strategies that you can use, many of which will depend upon your market assessments and the products and services that you will use, but we'll walk through all of those. And and then you have the deliverables down there at the bottom. We're beginning the build out of the 5-year template that Jim showed you in week 1. So remember our market capture planning from the end of the last week. Just to do that is you have ongoing marketing research. We need to determine what your products and services are. And then we walk through this TAM, SAM, SOM element of overall market knowledge to target knowledge, assessing your competition, and then by and large, what you will need in terms of marketing, sales, and promotional strategies to reach your client market. And then with any luck, with that kind of data, the pricing strategy takes hold of itself. So I'm going to stop share. I want to go to Jim's template here and make sure that I show all of you. So then I hit silver share. That's right. This is the financial template that Jim Franklin has built for the class. It's been very effectively used over a number of these cohorts. And I wanted to make sure at the end of the day when he highlights deliverables that we know where you start. So at its core, this is a 5-year projection. It has the 3 basic financial performance in it in terms of an income statement. You can see this. Obviously, this is summarized up depending upon your individual business, but you can see its revenue, cost of goods, and then a summation of all your SG&A expenses to get down to a net income and then a margin that can be tabulated from that. It has the second one, a balance sheet, which is assets and liabilities. Largely at this point confined to any debt elements that you may have in place, and of course additional equity investments and cash, along with the asset liability mix of any equipment any of you may have in your formal business plan. It's a cash flow statement that takes into account operations and your investing opportunities, as well as any additional financing that you need. But I wanted you for today to make sure that when we finish today that you focus on this revenue and cost schedule that he built for you. This is where we start, or we want your market caption numbers to end up. And you can see here what Jim did with the template is he gave you some good examples here. This is just an individual business, and you can see this business essentially projected revenue by building centers for students. They had a subscription rate for each student. And then of course we had to know how many students were attending from each center. You add these 3 up and you end up with subscription revenue. And this is a year's summation. So what we walk through in the second week where we show you that first year template, this is the end result, or what you add up after the 12 months of your revenue projection. The second year you can see is the number of customer centers has increased, and that goes through years 3, 4, and 5 to show the progress of the growth of your business. Now, many of you will have different revenue items here or line items, but this is just to give you a feel for how you develop your revenue element. In the case of this business, they not only had subscription revenue from contracts, but they also made money by undertaking and servicing government contracts. And you can see here, very simple formula, 2 contracts at $300,000 a year equals 600,000. You can make this as sophisticated as you want in terms of your revenue projections and the many line items some of you may have, or just a few, but this particular tab is where we want your market capture numbers to end up so that we can begin seeing the level of revenue that your business might be able to project. Now, a word of caution. This is really well done on Jim's part, and you'll be able to build your own. And what you will eventually see is that you can make these numbers almost anything you want. But I want everybody to keep in mind as you walk through your projections, that every time you put a number down here, whether it's in a month or over the year, you are setting a goal for yourself, and you want to have thought through how you will meet that goal. That's not only important for the success of your business, it's important for your conversations with investors, because particularly if you're showing growth, investors will be concerned that you can keep pace with that growth and whether or not your projections are realistic. So it's a truism. You can make an Excel spreadsheet say anything you want it to do. And one of the things Jim has introduced you in here is an internal rate of return. You can actually use that to sort of get an idea of how high your revenue needs to be. But when you're building this, keep in mind that every time you put a real number into one of these, you are setting a sales goal for yourself that has to be met, and you are setting yourself up for questions and Q&A from an investor that has to be realistic or perceived as realistic for your ability to raise money. So the revenue and cost schedule is the tab that we want the market capture results to end up in terms of that. You can see the makeups up here. This is market capture, both of these items. This is pricing, okay? In this case, a subscription price of $348 or a government contract that can be sold for $300,000. In the end, it's a really simple formula. It will depend on your individual businesses as to how you get to that. So focus on this revenue and cost schedule tab as your deliverable this week for the next couple of weeks. And it becomes particularly important as we re-engage with Jim in week 6. Now then, go ahead. Question. Sure.
The first one is, should a convertible note be in the balance sheet? And if yes, how should it be treated from a GAAP perspective, liability with footnote?
The answer to your question is yes. Jim, I'll let you answer that.
Who's that from?
TIL LLC.
Oh, that's Chris Bennett. That's right.
Oh, okay. Well, that's a little ahead of where the rest of the class is, Chris, but yes, it goes on the balance sheet. If you want to get a GAAP definition for where you put it, the best definition I've seen is that it is under contingent liabilities.
All right.
So you would actually add a column. You're right. I got you.
It's under, and it could be short or long term, but I would add another category that says contingent liabilities because ostensibly it's a debenture.
And Chris, we'll take note of that when we talk this week. I got you.
Second question from Sam. How do we create that fine balance of setting high goals for your business or unrealistic projections?
Oh man, we're going to get into that in a good deal today, because really everything that Bill's talking about is building the support for your projections. And then next week, when Kosha talks about sales planning, then even more realism comes into that about what you think you're going to be able to sell. But the questions we're answering are, why do you think that? because we're going to put some statistical basis behind it, to this week and next week.
I've got everybody.
Mhm.
Let me go back then. So I
I
stopped
hope that
sharing.
answers the question.
And
I'm
then
sure
just-
they'll say no if it doesn't.
Yeah, I think
Yeah.
we've got some of that, and whoever answered that question, we've got a number of examples, and we'll play through that. So once again, you can see here, Jim reduced this. He had this in the first week. In the end, your target marker is time, your capture rate is times your price is how you get to sales revenue. And you can see this was the build out that he gave you in that tab. And it is important, as you'll see here, because I'll speak to the pros and cons and when you may exceed the believability of your projections in terms of the believability when you approach an investor. And I've got a couple of good examples here that play that. One of the things to answer the previous question too is I'm a fan of walking through my first 12 months and actually thinking what I can get done every 30 days. That can often lead to you. I remember doing this course with Jim last year about this time, and we had an individual who was projecting a 9-figure, hundreds of millions of dollars in his first year, and it didn't take very long for Jim as an investor to look at that and simply walk through the 365 days in a year and realize that that was not that was an untenable situation. But often if you walk through what your activities are going to be over a 12-month period, you'll begin to get a feel for your ability and the risk you are taking in assuming those sales goals. So TAM and target markets and all of that, everything starts with customers. So remember, generally, take a look at your business and decide whether you're dealing with consumers, business, government contracts, or a combination of any of those three. And in the end, we want to make sure that you end up with a list, particularly if it's business to business and it's government contracts, and that list is substantial. For those of you with online businesses or dealing with individuals, a demographic profile that can be laid over a population or a geography. And then the marketing and sales materials that will allow you to get to that number should give you a good idea of the numbers that you're dealing with your business. And then we'll talk about offer and price. And then there's always the creative element of marketing. I never want to leave that out, but if we don't have the first two, the creative does not really come into play. Keep in mind, customers will vary as you engage them, and particularly as you engage numbers of them, you'll see all different times. This is just a combination of a couple, a customer that walks in, has a clear objection, no question, 10 minutes in and out. And then you'll, of course, tell the stories about the customers that love your stuff. They tend to buy more. They may hang around as well as though, but you'll deal with a wide variety of customer personalities as you engage your business and as you explore your customer experience. Generally, my experience is you have to be ready to react to all kinds of customers. I put here attaboys and complaints, and you can see these are generalizations, but you will walk into 10 to 15% who love your business, 65 to 70 who think your business is a good value. You'll always have that group that only buys on price only, unless your target market is to sell to those that only buy on price, which is a legitimate strategy, but keep in mind, very difficult for a small business to maintain because you have to have a whole supply chain that's built out to be the low-cost producer. You manage this by a consistent customer experience. You rectify complaints quickly on social media, deal with them because now they come quickly and they're advertised to everybody. For anybody that has any websites or social media presence, you turn attaboys into testimonials and you solicit attaboys for referrals. So many ways to react to customers, handle the complaints, and then leverage those attaboys and the folks who love you into testimonials and folks that can give you referrals. We ended last week with the overall market to the TAM market. These are the three elements: the total available market, or TAM, the service available market, or SAM, and then the obtainable market, which is where we're going to focus on Today, your goal is a list or a demographic profile that is substantial so that you can, that you know you have market potential for your business. I think we covered this pretty well last week in terms of the total addressable market as defining your industry. And as you research it, you want to get some feel as to where the market is going and its growth. Then as you begin to make your way through this, you start putting limitations on it based on your objectives. That can be geographies, it can be locations, it can be any number of elements, and those will all be different for all of you. In the end, then, we then have to establish a target marketing strategy of who will buy your product or service. And we want to define that. We want to put numbers on it. And we want to develop the typical sales sequence or purchasing cycle for that customer. That will help many of you become realistic as to what the potential is for your business in any 1 year period or 1 month period. That purchasing cycle and sales sequence, and I draw that out here in a couple of examples, will help many of you get very realistic about your ability to meet sales goals. And then we will do the market capture projections from that standpoint. Remember, total addressable market is define your industry, research how much is spent in that industry. We're looking for an accountable number here that's believable. Then your adjustments by any number of these, geography, economic regions, common sense are just a number of them, but we want to end up with a number in dollars that, as Jim and Tiffany and one of our classmates said earlier, is believable and relatable from an investor standpoint. In other words, they will look at it and say, yes, I believe the team that has been put together can accomplish those goals. Then we leverage that into a target market by knowing the problem you're solving. We look at the specific targets, and often you can work with investors on this, but that's where I think the 12-month look in the first year is very helpful. You can look at phases as to how things will develop for your business and when you're likely to start closing sales on an ongoing basis. An investor will demand that you'll be as specific as possible about that. They have to understand it, or they're unlikely to relinquish the funding that you might need. And then we build it into the 5-year strategic plan projection that Jim provided you in the first week, so that we can take a look at what's in it for the investors, as well as the growth prospects of your business. These are numbers. We want to end up with actual numbers of sales that you predict. And remember, you're right, you're doing a projection. No projection is 100% correct, but it has to be believable, and it has to be essentially a recognition by you and your team that you have established a sales numbers, you have told investors those numbers, and that those become legitimate sales goals, and they become business targets that you want to meet on an ongoing basis. Probability analysis gets interesting. I've actually spent more time on this, and I came to the conclusion, you see that right at the start. It's a lot of science and perhaps a lot more art, and it is a combination of all of those elements: your knowledge of the market, your prospects, your common sense, and then your planning. And that planning usually breaks down into a weekly sales effort before you send your sales and your marketing teams out to find new work and to leverage existing customers. I'll show you in a minute how to process a sales sequence in order to help with that predictability and cost. But generally, you are going to be doing 3 things from a probability standpoint. You will be prospecting and determining how many folks that make up your market and your chances of getting them. And generally that breaks down into several categories for most of you. You can see here, many of you will have new work from new customers. Many of you will start to get customers, or you will get contracts from businesses, and you'll have booked backlog that could be extended out into your projection. You might be able to grow that existing backlog. And then, of course, with those existing customers, you might be able to get new work. So this is a nice little probability analysis on how you can think through all of your customers. For those of you that get contracts or government contracts, like the one that was in Jim's element, you can actually project out into the second and third years and see if you can renew those contracts and if there will be more money spent. So you want to retain your base of customers. And then for all of that, you lay over your competitors. Your competitors are not only a threat to your business and your current element, but they are a source of potential new business if you can find competitive advantage. So it's worth tracking the competitive aspects of your business to see who you might be able to go after, as well as keep an eye on what your competitors are doing so you can respond to it. Then, of course, there are other things like adjacent markets and marketing positions. And some of you in the process of a 1 to 5 year element may refine your products or develop new products and services, which would add line items to your projection and allow you to grow sales. So you'll prospect, then you'll propose to these customers, and then you'll have to close them or capture them. Closing is usually a term used in business to business and business to government. You close a contract, but it's the same for individuals. At some point, people have to agree to pay your price, and you do that. And for most of you trying to put probability on this, if you look at a 52-week year, you can actually think through this week in and week out and do an assessment of where you are and the progress that you might be making. I think it's worth every quarter strategically taking a look at all of this. The quarterly assessment is a way perhaps to consider a new product or to have everybody in the room saying, hey, our customers are saying this, we need to add elements to it. But this, for me, has been how probability analysis has worked out over the years. I make it a formal sales meeting process. It happens on a weekly basis and is goal-oriented towards hitting the sales projection that we put in the annual plan, and then a quarterly assessment so that you can assign probability. And that's all I'm going to say on probability analysis. Let's give you a couple of examples here. Okay, so this is a decision-making example. It actually was a company. I've changed just a little bit of the elements and use some input from the World Wide Web. But the example I've got here is a startup technology company, and they offer an app. And in this particular case, the app targets small businesses that cannot afford the financial software to track inventory. This client actually started by looking at international markets. Just so you'll see down there in red, investor backlash. That might be a little large for an investor to take, but for this example, we'll use it. And in this case, they did their marketing research and found out that there were 100 million small businesses around the world in any and all sizes. The additional research that they did showed 43% of them did not track inventory. Now, are any numbers of that? Some people don't have inventory, but some people just do not have the financial acumen or have not developed it yet. But you can see the bottom line is they considered that their target market. So they took the 100 million and came out with a total addressable market of 43 million, considerably smaller than the 100 million based on their marketing research. Their additional research showed that 64% of these small businesses will not track inventory with an app because they are part-time ventures. And then 90% of these businesses that don't have an accounting application like this, which this firm wanted to be a premium accounting application, employ an in-house full-time accountant to track inventory. So you can see the research was showing they were getting this done by other means possible. As a result, this research really lowered the number of prospects. You can see we started at 100 and we got down to 15 million, to 10% of 15 million potential businesses. And you can see the decision making here. It lowered the market potential, except as a result of doing this, one of the conclusions of the management team is perhaps the accountants that were in-house and full-time would be interested in an accounting app. So you can see they lowered their market based on small businesses and perhaps found a larger market by going directly not only to the businesses, the small business owners, but to the accountants that are working in it. So you can see in this case, they developed a freemium model and they decided they would offer the application for free and then subscriptions for $100 a year. And that made their estimated total addressable market about $154 million. That's relatively small. And you could make the case that somebody might have gotten to this point and said, interesting, but perhaps not big enough. But if we just walk through the math that gets you to the revenue and cost table on Jim's element, if we talk about market capture or penetration rates, you can see if this business got 1% of the market that was available to them, their revenue would be about 1.5 million. If they got 5%, it would be 7.7. And if they got 10% of the market, it might be 15 million. And of course, this could be built out over a 1 to 5 year period based on the projection that Jim has given you. This is what I wanted to talk about. Some might look at this and say, well, we're going to be really good and we're going to get 50% of the market. And this gets to the individual's earlier question about being realistic. I can virtually tell you that if you walked through this analysis and then put it in front of an investor and told them that you were going to get a 50% market share, 1 out of every 2 customers available to you, you better have an awfully good reason, because most private investors are going to know most of the time that's very unrealistic. My experience is 1 to 10% is a realistic presentation to an investor, and then they will dig into the back and forth with you to see if they believe that you can accomplish that goal. So you can see this is an example of market capture. The cons in the pros in this business, where this is a niche service, it perhaps could be highly profitable, and it would have recurring revenue. In other words, the subscription would come up year after year. So you would have a growing base to be able to retain. And then you can see the cons. Current competitors are likely to react to this and slow progress. And there was, as we talked earlier, relatively small market potential. So lots of decisions to be made as you move through. But in the end, these are the numbers that can end up as sales projections that you can present. And I wanted you to have an idea of market capture and market share, at least realistic numbers that might apply there. And then keep in mind, if you start getting too high, I'm not saying a significant market or penetration rate cannot be made. But as you get to the higher percentages, investors will react to that. And you better be sure that you've got a really, really good sales sequence that makes it believable when they challenge you on that. So then I drew this out. Okay, I'm sorry. Go ahead, Chip.
Yeah, as an investor, I like to see you tell me how you got to your total addressable market so that it does become real. And this is a great example of saying, well, there's a lot of potential out there, but we're not trying to define that as where we're going to get there from here. Our addressable market, we get to our addressable market through this research. Don't be afraid to tell that story, because at the end of the day, then they'll look at 154 million as, well, okay, that's believable. Now, what is your confidence that you're going to penetrate or capture a certain percentage of that market? And that'll get into targeting. So,
gotcha. I drew this out. I have become a fan of sales sequences to projections. So you can see there in the case of this business, and I just want to show you what happens as you go through this process. They had an idea for an inventory app. They looked at small businesses. They actually found that CFOs and accountants and CPAs might be an additional market. They knew that they were going to have to reach this market as a result of it through digital marketing. Having a formal sales program or people reaching out and selling one-on-one to businesses was not tenable. They would have to do demonstrations still of this, which can be done remotely and over the phone and now with Zoom. And they settled on a freemium to subscription process pricing model. And so you can see their issues are they would have to think about people will probably take the app for free. The question is, how do you get the ones who start it free and get them to a subscription service? That's a legitimate issue with any freemium model. But in their case, the hope is that would produce revenue. And if they're correct, because it's a subscription model, there is potential recurring revenue. Down here in black, I want you to see if you walk through this element, a couple of things happen. First of all, if you're engaging and thinking of your customers this way, there's a natural R&D feedback loop, which will lead to improvements in the inventory app. That may very well lead to additional products or services. But down here in the bottom in black, you'll see they came up with all of the cost associated with walking through this effort. They're going to need a technology sales force. They need the talent for that. They're going to need a social media or a digital marketing plan. The things we talked about last week about technology roadmaps and platforms will be important. And they're likely to encounter this market and need ongoing R&D enhancements. And then in this particular case, they were looking at international markets, and there are service considerations to take into place. All of this ends up in your projection, and it will be the cost that are necessary for you to be able to get sales. So you can see all of these can turn into simple line items on the pro forma Jim has built for you. And you can think through what talent will cost, what a digital marketing plan is, all of those sorts of things, investments in R&D and all of that sort of thing, and put that into your sales projection, and you'll begin to see revenue minus expenses so that you know what's left over for profits. And then, of course, as we talked that very first week, let's not forget the managerial, the owner's salary, at least at introductory levels. So I want you to see, this is drawing out what we had on the first slide. And then you can see as you walk through the sales sequence and how you get there, the expenses will become apparent. And it makes it a very realistic way to be able to build out your income statement. This is another example. This was a startup company. This was one I worked with actually 4 or 5 years ago. They offered a maintenance service, a very particular one. And in their case, they believed they had developed a way to do something that was being done by hospitals that would save them about 18% off what was a required annual activity. They actually had to do it a couple of times a year. So this firm began by finding the number of hospitals in the United States. And at the time, I don't know if this number is still current, there were around 6,000. As a result of that marketing research, they also encountered the fact that there were 1,800 community hospitals, and it turns out they had to do the same thing. They identified another 6,200 ambulatory care centers that also had to do the same thing, except it was only required every 2 years for them. And then, of course, the walk-in, doc-in-the-box medical facilities were in the US. So you can see the marketing research into hospitals identified other potential markets. That did not mean, and they did not decide, as you'll see on the sales sequence charts, to service these businesses right away, but it did mean that there were adjacent markets that they might be able to grow into the future. Their market research showed that hospitals spent about $310,000 annually. That was all different depending upon the individual hospital. But you can see it was a very simple element to generalize that spend into 6,000 hospitals and to come up with a $1.8 billion total addressable market. In this case, the company value add was they were going to reduce that number because they had a value add service that meant the hospitals would not have to spend as much and that they would get the same result. So their SAM actually lowered the 1.8 to about 1.5 billion, assuming the 18% differences. Just so you all know, it actually did much better than 18%. So then you can see once they had these numbers, they applied penetration rates on a yearly basis. And this really fits the revenue and cost model. That's why I added to it that Jim put in there. You can see instead of, he actually had student centers. In this case, you would actually have the number of hospitals and the spend, and at 1%, that might mean you might be able to get $15 million in revenues. 5% gets you to $76 million in potential revenue. But you can see right here, the number of hospital goes from 60 to 300. So the investors or investment firms are going to be interested in your ability to show how you might get to that many hospitals through what turns out to be a direct sales effort. And then, of course, 10% gets to 152. And generally what you want to be doing here, I'm sorry, I got the figure wrong. That should be 600. You want to be starting using this revenue in your out year projections in years 3, 4, and 5, so that you can show the potential for growth in your business. The pros to this approach were there was a value-added sales pitch that they could take into any potential customer. There's the chance that it's highly profitable. It has recurring revenue on an annual or contractual basis. It turns out lots of hospitals put these types of maintenance services out for 3 to 5 year contracts. The team was able to identify the hospital ownership groups that they were going to be able to talk to. And you can see here with these other things, there was adjacent market potential in out years. All this from walking through a basic marketing research effort and defining the TAM, the SAM, and then the available market you might do there. In this case, the cons were this was a long lead time sale. You didn't walk in and get these contracts without pitching to an individual and then to a team. And so that had to be factored into the realism of how soon and how fast you could grow your business. And then, of course, this did not have a lot of intellectual property. There was a little bit of a trade secret on how they got to the 18%, but you can bet competitors were going to react to the potential loss of their business to an upstart that was pitching a better deal to the hospitals. In market research to sales sequence, you can see maintenance service to hospitals, and in the process, they identified potential adjacent markets. They determined the sales sequence was going to be solicitations and RFPs, so this was a direct sale. They were going to need a sales force to go out and conduct this, and that would add to their course. Then, of course, they had a decision, a contract, revenue, and the potential for recurring revenue if they could win those contracts over and over again. In the case of the firm, you see down here at the bottom, they elected to target hospitals first, recognizing that these are things that they could attack in the out years, and they developed the sales force to walk through the process. So you can see how this was used by them to make their decision and then target their market on hospital decision makers. And then you can see down here in black, all sorts of expenses become apparent. There's a sales force. You need the talent for that. This is a sales force that was going to have to travel at some point and visit hospitals. So travel expenses had to be factored into their budget. There might be multiple meetings, okay, in order to be able to close on a contract. And then, of course, they needed a website and then the service export business model to actually be able to do the work. So you can see once again, market research leads to targets, decision-making on potential targets. And then as you walk through how you get your customer experience, these black areas show all of the expenses that will become apparent to you that you can then add to your projection and see if you've got a profitable venture. I'll stop. Yes, go ahead.
Question from Mercy is, if your market research identifies new potential markets, how do you decide which market to service first?
Well, I would add realism, and this is a great example of exactly what Marcy is asking about. You can see here when they started, I remember them, their idea was hospitals, but as they did the marketing research, they found these other target markets. In the case of this firm, at least for the first year or two, they decided on hospitals because there were 6,000 of them throughout the country. That was a lot of target activity. They actually then targeted ambulatory centers as their second target market, but they did not start to go after those until their third, fourth, or fifth year. And that's because they had plenty of things to do when they laid out their first 2 years of activities to go after the hospital market. So Marcy, you will face the same sorts of decisions. It will come down to those individual elements. And the thought process this firm had, you can see, was hospitals was the biggest market, readily identifiable, and they identified the spend. It turned out in ambulatory centers, the spend was still significant, but less. So you'll have all of those kinds of factors that will help you make a decision. And in the case, just like you're asking, this firm decided that they went after hospitals as their target market first.
So I'm gonna
Go ahead, Jim.
So Mercy, I know what your business is, and I kind of know the question you're asking, but let me put it in a larger way to the class. I don't generally like the term low-hanging fruit, but when you're a very early stage business and you've identified a number of target markets that you want to go after, and you want to focus your sales force, which is going to be small in the beginning, I go after those. I target those pieces of the market that I think are easiest to reach, cost me the least to reach, and have the highest probability of successful closing. And I use that as a basis, because here's what people need to see that are either going to invest or lend in money into your company or lend to you. They need to see those early successes without a lot of failures. If you show a very inept sales force or sales effort, then that doesn't really generate revenue as quickly as you need it to. So go after the low-hanging fruit. The reason I don't like that term is it makes it sound simple. It's not, but go after that which is the easiest to show success at and to build from. So Bill has this thing, how they, they started out with decision makers at hospitals, which led to these other things, if you think about it that way. And hope, Mercy, did that answer your question?
Yeah, let's see if she's.
I hope so.
So far, yes.
Okay.
Fair enough.
Well,
Yes. It does.
Were there others? Or we're
No,
good?
that's it.
Okay,
Okay,
go
I
ahead.
have one that I know someone means to
Okay.
ask. So Bill gave you a couple of examples of TAM, SAM, and SOM, and he projected revenue from those. So one of the things that's going to lead into Akosha's thing next week is, and I'm sure Bill's going to cover this here in a second, in addition to projecting revenue, it gives your sales force specific goals, not just targets and not just leads, but amounts that become their goals for the year, quarter, month, if you want to break it down that way. And then I want to expand on sales cycles. If you, depending on the industry you're working in, and I'm specifically talking to Fertile here, you have a very long sales cycle if you're going after anything government related. And I think most of us that have been in that business for a while know that the sales cycle, meaning first contact to closing and revenue, is 2 years. And what investors want to know is that you're aware of that cycle, that you know it's going to take a long time to develop those, but particularly in recurring revenue models, it's worth the effort and it's worth the long sales cycle time, because recurring revenue by definition keeps going on. It's the gift that keeps on giving. Bill, could you? No. The probability that Bill went through, the probability there, you're going to see that you need to compute or use in your mind probability that you're going to be able to close. And as opposed to other probability statistics, this is sort of a continuum. It's not a one-time roll the dice kind of thing. So probability to us is more of a confidence level that you're going to close something. So one of the things I go back and do in my sales review meetings is I'll say to my folks, okay, you all projected this much for next year. What's your level of confidence that you're going to be able to close that? And if they say, well, I'm 75%, I reduce that sales number in projected revenue to 75% of what they've said.
Yeah, see, I'm with Jim on all of that. Frankly, you can find all sorts of sophisticated algebraic things on probability analysis, particularly with sales. But for me, it's just as Jim described. This is an ongoing daily to weekly effort. I really like. I actually used what he's talking about. I did it in a number of businesses where I would ask that question, Jim, and in the next month, if someone told me 75%, I took 75%. But as we got farther out into months 6 and 9, I would reduce to that. But both work. But you can see if you're engaged with your sales, okay, on a weekly basis and walking through these very elements, this for me is how it becomes probability. Plus, you're engaging your workforce and you're getting a really good idea of where they're at with individual customers. And you're seeing the success elements, because Jim's right. If you're not having success, that needs to be addressed. And then I actually thought of this, but I can't draw that well with PowerPoint. So, but Jim is right. This solicitation RFP element for this particular maintenance contract was an initial meeting and presentation, so firms could understand how they do. They then had to go through a qualification with the customer so that they became an approved vendor. And then there was a solicitation and an RFP process, all of which adds to the time to actually get to revenue. So Jim's quite right here. This one slide could have been taken out to 3 or 4 additional decision-making elements with a customer. And he's right. Your investor will want you to know you understand that, and you'll want to put a time frame on it as you put your projections in place on the financial template that he has built for you. Any questions or good there? And then once again, just keep in mind as you're walking through what really helps me when I'm looking at a new business or a new product is as I walk through that market capture and that customer experience, all of these other expenses begin to become apparent, and I can project them into the income statement. So that's what the little black things are down here. It's the emphasis element. But as you walk through this process, you will become aware, okay, of the expenses and the supply chain and processes that need to be put into place. And all of those can be reduced to cost numbers that are then part of your projected income statement as well as your projected sales. I'll stop there, see any immediate questions. In the end, it's add and subtracted, multiplied and divided. As I said, I've seen my fair share of probability analysis that gets into algebraic elements, but I actually I don't mind the term low-hanging fruit that Jim used. I know exactly what he means. But remember, that's targeting, and it's targeting your best prospects. And it's important for all of you to understand that while we've shown you mathematically how to get to this, to make your projection believable, you're going to want to make sure, okay, that when you put a sales goal into that financial template, that you think that you can hit it and that you can justify the way you're going to hit that sales goal to an investor. So with that, the key element that's left is pricing. And pricing gets all over the place, and we'll go through that and any number of options, since all of you have potential customers in all 3 market subsets. Introduction wise, pricing strategies are always interesting. I'm always hopeful someone has a reason to price at a premium because it has the highest potential. But always when you're pricing at a premium or someone suggests that to you, you have to take into account that once you enter the real market, investors will respond. If you believe that someone that you don't have any competition, you're just wrong about that. But if you don't have any direct competition, indirect competition is the simple question to yourself as to where do people spend that money now? Okay. Most of you will want a pricing strategy at the start that's for market penetration. It shows growth, and it allows you to develop a financial model that hopefully can show an investment grade return. Some of you may use value pricing. I'm not a big fan of the low price alternative for small businesses, but it's still there. Price skimming is really the term that they use for starting high and then adjusting based on competitive pressures. It's the whole theory behind this is it's a lot easier to start high and go down if you're marketing, if you're trying to find out what the market will bear, as opposed to starting low. It's very high. It's very hard to increase your prices because customers and consumers begin to learn that. There is a psychology to pricing. You probably all heard this. We say $9.99 instead of 10, and there is a lot of literature out there that says when you do that, people think the price is $9, not 10. So there's nothing wrong with employing this as part of your overall strategy. And then there are issues like bundle pricing, and we'll cover a number of the options. Keep in mind, price is important for your overall brand, okay? It's not just about the cost, although you always start there. But if you believe you have a premium brand, you need to price it accordingly, okay? And pricing can be used, obviously, to cover all your costs and to give an investment grade return, but it also can be used to create opportunity with new markets and things like that. And pricing can be used to incentivize customer behavior. We'll talk about that as we go through various examples. This is the price quality continuum. I'm sure many of you have seen it. You can see it's pretty straightforward. You can theoretically, if you have a high quality product, you can move up the chain up to a premium price. And then you have low price alternatives, which really are only in this bottom element where you are going to be the low cost producer, because once you get much farther along that, customers will not perceive real value, even if you offer a low price. For those of you into all the various types, I'm sorry, Jim.
Yeah, I like this, but go back one more if you would. Pricing strategy in just the big macro sense, pricing strategy, the way I look at it, is something that's going to get me successful market entry. He calls it market penetration here. But if you're an early stage product or you're a new business, something like that, what you care about is a price that's going to get you into the market or enter the market as quickly as possible, because from there, you can create the second goal of pricing, which is create customer loyalty. Loyalty is driven by price more than anything else, because the assumption is quality will kill you. It won't necessarily get you loyalty, because there's a lot of that, but pricing. So your initial pricing of your product should get you entry and customer loyalty, which leads to opportunities for follow-ons and things like that. And if you attach a price to your brand, or you get identified with the wrong kind of price with your brand, it can dictate decades of how your business has to go. So let me give you an example. Sheeta's sitting here and she's got artisan jewelry that's the best that I've seen in a long time. It's very, very high quality, made out of, native products, if you want to call it that, but it's also very pretty, it's glamorous, all that kind of stuff. If she were to price that, which she started out doing, at too low a level, people are going to put against her brand low price, high quality, which you would think would be good, but the reality is people don't trust low price, high quality. They believe that something else. Also, if you're an artisan or you're somebody that is touting yourself as high quality, and that's the kind of customer you're going after, make sure you're pricing it high enough. So for the artists in the world, I always say, as an artist, you can price it too high and offer deals. You can't price it at a deal level and come back and get more. So anyway, sorry, Bill.
So you just had a great example that Jim gave you of using good pricing to incentivize customer behavior. Actually, now I wish, Jim, listening to you, I had added and targeting your markets.
Yeah,
So
exactly.
it's a very, very good example. The I put this in here. This is just for those of you who get the PowerPoints. Bain and Company is one of the world's major management consulting firms. They do this nice chart that shows you the emotional elements of pricing. I never claimed to understand this, but it's a nice chart that shows you how the typical consumer, those folks in that 65% range, generally react within markets for apparel, smartphones, and all of that sort of stuff to quality and where it sits on a continuum from low to high. And I put this in here just because I thought many of you might look at this and see some value in it as you try and figure out where to price your products and services. And it's a well-established value chain that's been around for a couple decades. Keep in mind, we're looking for a return to investors that will probably occur over years three to 5 years. And prices have a life cycle, and they start at introduction, they grow. They sometimes can get higher if for no other reason than inflation and curse, but they will hit a maturity level. They generally decline over time. Something to take into account as you look into those years 3, 4, and 5. This is also true often of the products and services you offer, so you can see pricing is just mirroring the general give and take with your products and services. So the pricing process, 2 elements. There are some straightforward steps, and then always we want to know your cost. So we can walk you through the steps, but if you don't know your cost, we are setting up for what Jim just described a few minutes ago. You might charge too low a price and not be able to make money at it. The steps are fairly straightforward. You want to be able to assess your markets and the marketing and the segment that's targeted for the price that you're going to charge. And I want to reiterate, just to come on with Jim, for small businesses, and most of you, all of you at this stage are small. By and large, there is a lot of history that suggests that you should start high and then adjust based on using some price adaptation strategies we'll talk about at the end here. So most small businesses that make a mistake in setting price do so because they start out too low. And so that's just a real good follow-up, I think, to what Jim started. If you're fighting with that with yourself, start with the high price, and then we'll work from there. Jim pointed this out in the first week. You need a wholesale and a retail price, and you have to know your cost to be able to determine what they were, what that will be. Because if your target market turns out to be wholesalers and the retail market is going to be down the line, the retailers have to be able to mark up your product in order to be able to make money on their own, and you might need the wholesale market in order to get access to those horizontal markets. Very important that you do a competitive analysis. Always worth looking at similar products and services. Once again, even if you believe you don't have direct competition, look at where customers are spending their money now for a similar service or product, and that will be a good place to start. And we'll hope you really do have something unique that can be priced at a premium. But don't kid yourself by thinking that there is not competition out there. At a minimum, there is always the case of what people are doing with their money now, or the fact that they're not spending it with you. I like to lay it into a comparison table. I like the comparison table actually because it makes you put all your competitors down, and it's a likely question from investors that you have done a competitive analysis, and once you put them all down and you have put in the prices that they are charged, it allows you the necessary data to make decisions along these lines. It's worth walking out and talking to lots of customers in your target market to see if you can do a little survey and determine their willingness to pay the price. And you can do this in pilot studies at the start out element or as you enter the market, but this gets into the whole area of trying to make sure that you have a product or services that someone will pay a price for during your primary marketing research. And then as always, pricing is not one and done. You'll reassess and revise as necessary. Jim just spoke to that a few minutes ago. You can start high and always come down using a variety of adaptation strategies we'll talk about at the end here. Do we have a question?
What goes into cost other than materials?
Interesting, you should ask that.
Right.
So one, we want you to know your cost, and you can actually look at your competitors and see what they do to start to build this. But what goes into cost is pretty straightforward, and it ends up on your income stream. One, I always like to look at the product services and find out exactly what it takes for me to deliver that product ready for sale. So in the case of this vest, since we have you here, when she's making her jewelry, she has labor associated with getting that jewelry and materials that I would put in cost of goods. And then I would stop there and come to a gross profit margin. So the first thing is the knowledge of your cost of goods. Some of you will have services and you may not have a traditional cost of goods area, but those of you who are producing actual products, you want to find out what is actually entailed in getting that product ready to be sold, and that's your cost of goods. Then the other two elements are the fixed costs, the things that you walk through this process and you find out you have to pay month in and month out, and they are generally the same. Rent is usually a good example of that. If you need office space or you need a facility or a warehouse, that will be a cost that will come due every single month, and it will be the same except for probably increases built into a lease which occur every year. So you might sign a lease that says it's currently $1,000 a month and it will increase 3% every annually starting on whatever your lease says. But you will run into those costs that are fixed, and these can be any number of things. Telephone expenses and things like that can be that. Fixed costs generally only go up as you start to scale. You add people or you add a lot of people so that you need more space. But generally, you can look at those things that are the same month in and month out and put those into your income statement as fixed cost. Then they're the variable cost. Variable cost are things that change based on activities month to month. A great example here, based on the examples we showed you, would be travel cost. Some months you might have cost, you might not spend as much as travel, and then the next month you're in the process of closing 3 sales. That requires you to travel out, negotiate contracts, and your travel expenses went up. You do your best to project that based on the sales sequence or the sales cycle that Jim talked about earlier, but those expenses will be variable. In my case, it is always a tough first year to determine these for small businesses, but once you get out and you can see what happened over a year's time, it becomes easier to project variable costs because you'll get an idea of what those variations are. Many of you will have seasonal elements to your business and things like that. And you'll actually be able to know what those changes will be literally on a month-to-month basis. But cost of goods, what it takes to make your project, your product or your service, because some services do have a cost of goods, your variable cost and your fixed cost, that's what makes up an income statement or a profit and loss element. And then in the end, we'll see what the profit is that's left over on a month-to-month on an annual basis. Your balance sheet can all, go ahead. Okay.
I want to make this simpler for you. The common way to do this, if you are a product or a service, is to figure out the absolute direct cost of you doing what you do, of you producing what you produce, because that's really the only known thing you're going to have. So we keep picking on Sheeta, but let's do it again. So she sells a beautiful set of earrings for $35. Now, how did she come to that? Well, the labor or the time it takes her to do that set of earrings and the materials that go into it and the package that it is contained in along with the printing, she knows the cost of all that per item. So she takes that cost and multiplies it by a multiple. Roughly, in the retail world, your retail or manufacturer suggested retail price is going to be somewhere between 2 and 2.5 times your cost of goods sold. So if you lack anything else, you're probably not going to lose money if you double your cost of goods sold for your unit pricing, because that will include now some of your variable costs and your fixed costs and all that kind of stuff that you'll get to later, but you're probably not going to underprice yourself or do what I call putting a check on everything you shove out the door to sell to people. So that's a simple way. Now, the difference between wholesale and retail is a little bit more art, and that takes negotiation. But what you do is you walk into a wholesaler, or let's say in Sheeta's case, she walks into a retail outlet and says, at the wholesale level, I'll sell you this, because you're going to have to sell it the same price that everybody else is. So that $35 set of earrings that she's selling at the retail level is going to come down to what that retailer will be able to mark up and make their money at. And it usually your wholesale price is somewhere around 70% of your retail price. So if you're selling something for $100, it means you got $50 of cost of goods in it, and you're going to sell it at the wholesale level for 70. Then they can mark it up to 100. Is that? I hope that clears it up and makes it a little simple, because we're going to get complicated from here.
Yes, I actually am of the fan that you just have to get complicated about it, but Jim is quite correct. I've used that under the terminologies of milestone markups and things like that, various elements, and it is certainly one way to do it. I always wanted to know my variable and fixed cost. Frankly, it helps you build out an income statement too that has all your costs taken into account.
Yeah, and for those of you doing government contracting, that comes under the head of what you're going to charge for overhead.
Yeah.
It's cost, and if you don't get that right, or you overestimate it out of allowable tolerances, the government can reject your bid out of hand. So, sorry, go ahead.
I didn't want to leave out the balance sheet element because many of you will have to track inventory and other assets like accounts receivable and things like that, but that can be factored in because there may be cost of money associated with the flow of assets through your business. But you can see this was an attempt to be very comprehensive, and then Jim gave you some solid rules of thumb. I've always called those milestones markets that apply to many and can be helpful. Frankly, thinking through it now, you might want to start with what Jim said, do your homework on all your cost and build it into the income statement so that you can look back and see what those, whether those milestone markets hold up in terms of actually getting out there and finding out what the market will bear. Was there a question that I missed there? So go ahead.
Should you lower your cost in the beginning to build clientele?
Lower your price or your cost?
I think she meant price.
Yes.
Yeah, your introductory prices, like I said, are to get you market entry. But here's a caution. Your introductory price, whether you believe it or not, is going to become the maximum amount that anybody will pay, particularly if you are an online product provider. Because everybody knows the history. If you charge $10 to get, a loss leader into the market, people are going to be very reluctant to spend 15 on it when their buddy just got it for 10.
I think Jim is so right about that I was just going to answer no.
That's what I was going to say.
That's right.
She's actually, I know her business. So I would say, do not lower your price. Make sure first and foremost that you're covering your costs, especially since you're making everything by hand. And, as Jim had mentioned earlier, you can set your price and you can always lower it, but you can't really raise it because everybody's going to get used to what you're charging for your products. So make sure you're covering all of your materials and your supplies and your time. But set your cost at what it is. Make sure you're making a profit and you're paying yourself.
Some ways also to lower that market entry pricing to somebody that I call participative pricing, which means if you come in and you're a first buyer of something, then I'll give people coupon reductions, without lowering my list price,
Right.
coupon reductions or referral reductions.
Right.
That loyal customer that Bill described back about 4 slides ago that leads to referrals. Now you can start lowering your price to those people that are big referral people.
And Jim and Tiffany's points are well taken. In the final 3 slides of the presentation, just we talk about price adaptation, and they bring to bear just of those things, a much better approach than starting with a low price. I think they're both right. You're just teaching your clients the price that they can expect in the future, and then you may run into that low price, high quality element that begins to make customers doubt whether or not you are giving them a good deal. So
and investors doubt whether you're going to survive.
And investors will doubt. Yeah, that's right. Very good point. So here's an example just of how you can take, and I didn't use the milestone market. I tried to give you an example that shows fixed and variable cost. And I made it pretty simple. This was Start Enterprises. This is a pizza sale. After they walked through and did their market analysis, they looked and thought that they would be able to sell $500,000 worth of pizzas in a year. They make about 400 pizzas a week. That was based on their supply chain. And 500,000 in revenue. And they make 400 pieces a week or 20,000 pizzas a year. Their fixed cost include rent of $4K a year or $48K. So that's an example you can see of their fixed cost. Their variable costs were cheese, meats, veggies, all the things that go, man, we put everything on pizzas these days. Direct labor, all of those things can be added up, okay? Other examples of fixed costs are insurance, manager pay, your lease and all of that sort of thing. And in this case, you need to make sure all of these are fully absorbed in your pricing the way Tiffany was talking about earlier. So you can see it becomes a simple matter of math, but once again, you have established a sales goal, okay? If you have 48,000 in lease costs and you want to recover that, and you decide that you're going to sell 20,000 pizzas a year, your cost per pizza is $2.40. But remember, you have set a sales goal for yourself. If you only do 10,000 pizzas, that means you're actually losing money per pizza, okay, in terms of covering your lease cost as you projected. So keep in mind, once again, we can make this math work, but we want to make sure that you realize that when you put a number on something for a sales goal, that becomes a target that you want to hit in your ongoing effort. The same process would apply. You could loop all of these together into all of your fixed cost and then divide them by 20,000 and come up with a fixed rate. In this case, the client actually looked at the competitive market, and they found out that they could price in the competitive range at the time. And I think this is still pretty close. I just did this a couple of years ago. Pizzas were selling for $9.99 to $14.99, independent of the various sizes and wedges and tops like that. And then you can see here, as you look out into that second, third, and fourth year, many of these costs will go up. So as you look into that second, third, fourth, and fifth year projection, in addition to the scale that you are trying to build for growth, keep in mind, traditional expenses will generally go up 3% a year, and that was true for about 15 years up until this one. So you'll have to look, inflation has taken a little bit more hold over the past year in our economy than it has for the past decade and a half. So just keep an idea of what costs are rising. You will often find, if you do this through the income statement method that I'm suggesting, you can look at every line item and you'll find some cost will stay level, some cost will go up substantially, some cost will go up only. Partially, some costs may go up just because you're scaling and growing. But just a good example of doing the simple math around the sales goals you set to make sure that you capture those fixed and those variable costs. Then we're into pricing strategies, and I sort of put these from, well, I put them from most typical to least typical. Many of you, unless you have intellectual property or something like that, will do this research, and you will be in highly competitive markets, and you will need to make sure that your price is in the competitive range, particularly if you're bidding on contracts. If you have something that really improves the process, like our folks with the hospitals, you know that your price is going to be lower, but still be as profitable or maybe a bit higher than what competitors are offering. But that's because they were seeking to disrupt their market. For those of you with more standard products and services, you'll want to do a real good analysis and make sure that you price yourself in the competitive range, and then you compete on things like service, relationships, and customer experience. So you still will compete, but generally you want customers not viewing you outside the competitive range on pricing. Cost plus pricing, something that can be used on some government contracts, or as Jim, I think this is a good example of the milestone example Jim gave you. You determine the selling price by adding a percentage markup to the unit cost of your product. That's exactly what he was describing to you earlier. So you start with what it costs to make, in this case, this best jewelry, and then you add a profit margin, or you add a percentage markup, I think, not just a profit margin, as Jim was talking earlier. And you have a good example here. $10 are your cost, and price the item at $15 will provide a 50% margin. That would generally, as Jim said, be seen as a forgiving margin, and one that's likely to cover your other SG&A costs. So this is a good example of what Jim was describing to you earlier. I know we have technology firms, and platform pricing has become a methodology that's used by many, if not all of them. They give away something, or they give access to their sites, which they are building out and scaling, and they make money some other way. Usually it's through advertising, but there are any number of ways to use platform pricing, and you can simply scour the social media platforms of the world to come up with this. I thought Jim would appreciate this, frankly, and one of the things that he's done a great job with in the financial template is he has given you a tab where you can actually do your sales projection minus your expenses and show your ability, at least by the out years, to show an internal rate of return that will be of interest to an investor. This is a very mathematical way of making sure that you get that return built into your pricing from the start. What it leaves out is the market overlay. Okay, so you have to be careful with this, but if you want to say, I want to make sure each one of my products is producing, okay, the potential to give an internal rate of return for, say, 20% or 30%, you can use this formula in order to be able to do that, built around your unit cost and then the desired return on invested capital, which you would probably, based on what you perceive investors will need to do that. Now, keep in mind, this is a very tried and true way to do that, but you always then have to lay over the competitive market to make sure that the price you end up with is competitive or within that competitive range, or that you have some unique quality or intellectual property that would allow you to charge a higher price. Value-based pricing, you essentially you start with what your customers are willing to pay. I actually write this out in a formula that says, I start with the price, and then I have to build my cost and my profit I have to build my customer experience so that I can get the profit and the cost in a range that allows me to make money. So I actually start with what the customer will pay. I spent many of my years in the construction industry and the engineering business where there were plenty of competitors, and we knew what customers were willing to pay. And so we built our customer experiences and our services around starting there and then backing in to our cost to make sure that we could do it in a competitive manner. And then you see the example here, charges $25. The customers perceive your product as higher quality. You may choose a price of $30, and you've heard from Tiffany and Jim earlier that that would be the better approach than perhaps charging a lower price and running south of what the higher quality is of the product that you have built. Flat fee pricing is pretty straightforward. Customers pay a flat fee. This can be on a monthly or an annual basis. Sometimes it can be annually. It's a nice pricing strategy. It's straightforward. Customers can easily understand it. They can immediately assess what it's going to cost them. You may miss opportunities depending on how extensive your product line is to customize pricing based on the many ways they might use it. And you have to be careful here to make sure that your cost is in the competitive range and not prohibitive for some customers. Even those of you with a very new product or some intellectual property may need to test your product to make sure that customers will pay at the range, particularly if it's higher than what their normal fits. So that gets into the primary marketing research we talked about in weeks 2 and 3, just to make sure that you're not building someone that people will either not pay the price or that they can't afford. Freemium pricing is a favorite. It grew out of the technology sector, I think, unless Jim, you tell me there's enough history around it. But lots of technology sites start by giving away the product, and then they have additional features, and they hope that initial exposure to the free product gets customers interested in those additional features, and then they begin to take on those additional features, and of course those come with an additional price. Lots of technology firms do this. It gets people using their site or using their social media model or using their service model, and it's been largely effective. Its great risk is the third element there about markets who may never upgrade to a paid account. And frankly, you will experience a fair amount of that because lots of people will do things for free with never an intent to buy. But if you have a product whose additional features have appealed to a target market, you are likely to be able to use this strategy and people will buy into the upgrades. Usage prices are where you lay out a number of things that prices can do, and then you price it based on the features and the things that customers buy. It allows a certain control on what customers can pay. It can discourage customers from using the product more because they know every time they touch an additional feature that the price goes up. But once again, if your targeting is targeting is done correctly, you will have some of that, but you'll be able to use this as a pricing strategy. Per user pricing used to be how lots of IT firms did this. They would go in and offer and build out IT infrastructure in many small and large businesses, and they would simply charge based as the customers rolled that out into their customer base. In reality, I think a great deal of this has given rise to more flat free pricing because customers have more control over that. So they tend to negotiate that up front. Nevertheless, it is an option, particularly for technology firms, and it can be rolled out and allows you literally to control your cost customers by customers. It can get complex. And as I said, I think over the history of technology and IT services, their per user pricing policies have become more annual flat free elements. Tiered pricing is where you have select target markets that have different needs. and you want to service all of them. So you develop a tiered pricing model that allows people to take advantage of the only feature they need or the additional features that they need. Obviously, its advantage is it allows your target market to attract a wider range of customers, and it allows you to deal with folks who have different income levels. It is and can get quite complicated, so many options can be seen to confuse customers. Nevertheless, it is an option and it's used by any number of businesses. Features, I'm sorry, I put this in twice, is the same. This is the value add-ons that we talked about earlier, and I just made a mistake and added a extra slide. Those are good examples of standard pricing activities. All of those I put in here as individual slides, so all of you can look at them and give some thought into what your pricing strategies may be over the course of your, particularly those of you who are initiating activity and attracting your first customers. It will give you a real thought process to add to your thinking as you try to put that price on those target markets and come to the revenue projection that we want on that tab that Jim has developed for you. Jim and Tiffany touched on this earlier. So once you've developed your strategy, obviously you will hit the competitive markets. And as they have told you, nothing will stay the same. These are just a couple of slides to finish out on price adaptation strategies. They generally fall into three areas: price discounts and allowances. As Jim said earlier, you can always start high and come down, and coupons is on that slide, the very example he used you. There are promotional pricing activities that can be done literally for those of you in retail markets almost on a weekly and certainly on a seasonal basis. And then some of you will have to respond because your competitors will respond, and you may need to adjust accordingly. So discounting is pretty straightforward. That means you're going to give a break on your price. And just remember these rules. Perceptions matter. Once you start to discount, you may be teaching your target market to expect discounts on an ongoing basis and to wait until you do so because they will get it at a lower price. If you discount, you take the chance that your your competitors will react. This is how price wars are created, and generally price wars do not end up being beneficial to anybody except the consumer. So keep that in mind. This is not a decision to be taken lightly. Discounts lead to customer expectations. And then, as we all know, discounts aren't fair. I, for years, have asked myself why I have been a customer for Cox for 20 years and I can never get the introductory rate. And that's because they're trying, as Jim said, to get penetration with the customers who haven't bought into it thus far. So leave the conversation about fair out of your conversation. Just make sure it doesn't create any of these other factors if you start to discount for reasons that your competitive market seems necessary. Couple examples: quantity and bulk discounts, seasonal discounts. This can be a way to drive traffic in low seasonal elements, allowances and coupons and things like that, and trade discounts. You already heard Tiffany and Jim speak through. Just keep in mind when you discount, you don't want to do this without having a strategic objective. In other words, you're doing this to create loyalty, one of the things Jim said earlier, or perhaps to drive additional market during a down season. Just make sure you're always thinking when you're discounting that you have a strategic objective. You're not just dropping the price. Promotional pricing, this is what Jim and Tiffany were talking to. You can have special events. This can get into unit elements and things like that. Cash rebates are a way to be able to do that. Low interest financing actually exists in this best worlds from time or no interest financing to buy higher price pieces that she may sell. Longer payment terms, warranties and service contracts are value add in the competitive price area. Loss leader pricing is always interesting. The typical example here is sell the razor and then make money on the razor blades. And I think they actually do, although razor blades can cost a fair amount of money, but maybe it's just their cost. And then we talked about psychological pricing earlier, but promotional pricing is another example of price adaptation. Keep these slides available as you move through your first year, and you meet the third element is responding to competitor changes. And these essentially are your options. You can maintain your price. You can maintain it by increasing your promotional activities and teaching your customers that you're worth it, just reminding you of that. You, of course, can match the competition. You can also come up with a little adjustment to your price and your service. Keep in mind, your customer has to believe this, okay, that you're improving the quality, but you could actually move up there. Just remember, this has to be not just in your eyes, but in the perception of the customer experience that you're given. And one of the things you can also do is launch a low price alternative that perhaps has lower cost and allows you to make the same amount of money at the price that your competitors have engaged you with. That takes a lot of supply chain knowledge and things like that. But nevertheless, these are the standard responses to competitor price changes. And all of you will encounter this through probably within the first year of your business, just because competitors will not sit idly by based on your new offerings.